Hey there, guys. I just wanted to put together a short little video here just to help provide a visual and a better understanding of an answer or provide an answer to this question, should I refinance? Okay, I get this question a lot lately. Should I refinance? Should I take advantage of the lower rates? Should I refinance? 5, 6 times a week, this is the phone call I'm getting. Just to start, a refinance is basically trading in your old mortgage for a new one. And oftentimes when you trade in that mortgage, you'll likely register it for a different rate and oftentimes increasing a balance on it. Okay, so this is the scenario that I was faced with recently, and I wanted to share that with everybody. All right, so what happened is I had a couple clients come to me and they asked me if they should refinance. So they were going to trade in their mortgage for a new one. And they had 2 reasons for asking me. One, they were talking about potentially lowering their mortgage rate to have less monthly payments, but also they had some debt that had accumulated, and they thought, what if we use our new mortgage to pay out some of those debts? And I thought that was a great plan, but I wanted to run the numbers for them first and ensure it worked for them. Okay, so what we're going to talk about today is we're going to talk a little bit about a pre-refinance and a post-refinance. All right, so what I'm going to do is I'm going to show you what my clients' liabilities, mortgages, and all of and credit card debts were like pre-refinance, and then the deal that I got them post-refinance. Okay, so my clients came to me, they had $95,000 remaining on their mortgage, and they were paying $1,049 a month. All right, that was just mortgage payments. They had a car loan for $550 a month. They had an unsecured line of credit with their bank. They were paying $500 a month back. One of the clients had a personal loan for $350, okay? And they had credit cards that when you accumulated them, they added up to about $150 a month. So in total, when you add up all of those monthly liabilities, my clients were paying $2,599 a month to repay these, okay? So with the refinance opportunity that they came to me with, I thought, okay, well, they have a great idea, so let's see if the numbers work for them. So we looked at this $95,000. And when you refinance, like I said at the beginning, you trade in your old mortgage for a new mortgage and possibly a better rate and a new balance. So what we did is we looked at the value of the car loan, the unsecured line of credit, the personal loan, the credit cards. When you added up all of those debts together, it equaled about $55,000. So I looked at taking this $95,000 remaining on their mortgage, and I looked at adding $55,000 to it. Instead of paying a car loan, which is at, let's say 2.9%, unsecured line of credit, their rate was around 6.45%. The personal loan was around 8%. Credit cards, we all know credit cards, very, very high interest, okay? What we looked at is we took that $95,000 and I rolled in $55,000. And what that would do is it would provide my clients with money to pay all of these debts off all at once. Okay, so we looked at registering a new mortgage for $150,000, $95,000 that was remaining, plus the $55,000 that would be provided to them to pay out those debts. All right, I got them a much better rate. Okay, my clients had a variable rate mortgage. Prior to refinancing, I was able to get them a variable rate mortgage of 1.45%, which was lower than what they were paying, which was wonderful for them. Amortization basically means taking your loan and stretching it out over a variety of years. Okay, and if you keep that loan consistent and you pay it back every month over those years, you will pay back that loan. In their pre-refinance, they had 15 years remaining. So I didn't want to change that. I wanted to keep the amortization at 15 years for them. So we kept it at 15 years. At $150,000 with a rate of 1.45%, I was able to get them a new monthly mortgage payment of $928 a month. Okay? They were paying $1,049 a month. Now they're paying $928 a month. But what's even better is they're paying less per month, but we've now received $55,000 to pay out all of these debts. So at the end of the day, my clients are saving $1,671 a month because they no longer have these liabilities since they've been paid. So my question to you is, what would you do with $1,671 a month? I know what I would do.